Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with my good friend, Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
Absolutely, buddy. So this is going to be an interesting episode because in episode one today, we talked about stagflation. Kind of it's staring us right in the face. It's this week's a big deal, right? CPI, retail sales, consumer sentiment. We got Kathy Wood calling for it now. I uh I want to just use your wealth of knowledge. I want to pretend it's a year from now. Let's pretend we're in a stagflation environment, which means slow to negative growth and high inflation. What are some things you might be doing a year from now, assuming we're in it? Because stagflation won't be a short term, like 3 month thing. It will last a while, is my opinion. What do you think?
Yeah, it could. The thing is, what can the Fed and central banks around the world do in response, and what are going to be the effects of that? And you just can't. The government can't grow the economy.
Mm-hmm.
Bottom line, end of the day, banks, governments cannot grow the economy. It takes demand at the consumer level. So
Mm-hmm.
the real key is going to be, what does the demand look like? What is our output capacity, and what are the headwinds at that point? But for me, whenever you're in those types of environments like 2008 and 9, was the big one that I went through, and I've seen little ones since then, peaks and valleys. Is that you don't want to be buying the dips, because he who buys the dip becomes the dip in
Yeah.
an environment like that,
Yeah.
because you don't know where the bottom is, right? So what you really need to do is you need to wait for that bottom, and you need to wait for the recovery of the uptrend. So at some point you have to understand where values are going across the board, whether it's markets, real estate, any type of asset, where the potential bottom can be, and when it's time to step in, and what your opportunities are when you do step in. So where's your growth going to be in that environment?
Yeah.
So we know, number one, housing. People have to have a roof over their head. Number two, you need food. Everybody's got to eat. Number three, you need medical and healthcare. Number four, you need education. Number five, you need clothes on your back, right?
Yeah.
So those are the core essentials that everybody needs, to keep moving forward. So when you look at those core sectors of necessity items,
Mm-hmm.
that's the first area to look for your opportunities. And then you go beyond there as things start to recover, and we start to catch up with growth. The economy is growing, the population's growing. From that regard, so you're going to have a certain amount of growth just because the population's growing. But at the same token, things can only go so far so fast, and we've had a huge uphill bubble here, since 2008 and 9, that needs to unwind a little bit. So it'll be interesting to see how it unfolds.
Yeah. Again, I'm a real estate guy, residential, at least currently, mainly. I think there's going to be huge opportunities in commercial in the future, but not next year. So for me, the big question for what I'll be doing is I'll still be looking at my residential real estate, probably houses in my market. Others might be duplexes, tris, and quad. I want to stay residential because I believe one of the most powerful things you're going to have is the 30-year fixed rate mortgage. So my biggest
Mhm.
question is, if we're in a stagflation environment, is the 30-year mortgage rate, 3.5 or below? Because there's talk about it going below 2, which is crazy.
Yeah, if you're in a stagflation environment, that's the one thing that can't change. You can't raise interest rates, because you're not necessarily, you're going to have inflation to a point, but what's the results of inflation are people stop buying, they stop spending.
Exactly.
So
Yeah.
that'll take care of itself. So that's why you get low growth, because inflation goes up, prices go up, people quit buying. So you get stagflation. So I think rates are going to have to stay low, because that would just be that would just kill everything. Then
Yeah.
you're in depression.
Right. Yeah. We
And
go from stag. Yeah, absolutely. Yeah. Yeah. So I totally agree, because that's where my head's at. That's why I'm so focused on residential, because again, this isn't a worldwide phenomenon. People don't realize that the 30-year fixed rate mortgage that we have in the US is not global, right? If you go north to Canada, they do 5 years, their longest fixed rate period. I personally would not be buying a property today.
yeah, but some countries do 40 and 50 years.
True.
So,
No, yeah, it goes both ways.
it's,
Yeah.
yeah, it's all across the board. Now, here's something that's really interesting, about all of this and where this could potentially go. So, we've talked about MMT, modern monetary theory, on here a little bit,
We
here and
have.
there, essentially, which is, governments don't have to balance their budget like we do.
Yep.
They have unlimited spending capacity, because they create the currency that is the reserve currency of the world. We can issue it, therefore we can never run out. So we will never default on debt. We'll never be able to not pay our bills. We'll never be able to print whatever we need. So here's the interesting thing. A lot of people, are crying out right now because of all the money that's been created and put into the economy in the last year. I guess it's more than in the last 10 years, just in this last year,
Yeah.
because of what happened with the coronavirus. A lot of people are freaking out saying that's going to devalue the dollar. We're going to be in so much trouble, So here's the thing. The Great Depression happened because the government didn't step in.
Exactly.
We didn't do the things that we did 2008-9 and that we're doing now. And we stopped a global financial meltdown to the level of, and probably even way worse than the Great Depression. So, which would you rather have? Would you rather have a depression, or would you rather have what we're dealing with now, which there are seemingly no consequences?
Yeah. Well, yeah, there is a consequence. It's harder to get on the property ladder, right? It's harder to become an owner today. I think is one of the consequences people are pointing out, and that's true, right? The down payment required is larger today. It's a percentage of income. It's up there, but yeah, if you're a young millennial, whatnot, getting a Gen Z, getting into the stock market, you're clearly buying at a peak, right? If you're doing your 401ks, there are buying at the top can be risky, right? But back to what I'm thinking about for next year, given stagflation, we're in it a year at this point. If rates stay under 3.5, which I think we both agree they would, because if they raised rates, would be done.
It's got to stay under 4. I don't see it getting over 4 anytime soon, because that will kill the real estate market.
So again, if I'm in that environment, I can still get 30-year fixed rate debt, or because again, I think one of the outcomes of this could be the introduction of a 40-year mortgage. It just, right. Anyways. So the other thing I'm going to be looking at is rent. Rent has been skyrocketing, and I think rent continues to increase. So if I can get 30-year fixed rate debt, make sure it cash flows day one, I can hold for a decade. The 70s are an example. I just looked this up yesterday. So we talked more about the 70s because of inflation, right? It was the one decade where rates went up.
And the styles are coming back. Your shirt, that was hot in the 70s, man.
Yes. Thank you very much. That was awesome. Good call. But what happened was, so housing went up 100%, 106. Incomes went up 88. I just saw this. Rent went up 125%.
Wow.
Yeah. So again, if I can buy a rental, cash flows day one, I can hold it with fixed rate debt so my payments don't move, and rents go up 125% in a decade, I'm feeling.
Yeah, you're in good shape. You can't count on that.
No, you can't
put your business plan based on that. It needs to cash flow from day one.
Day one.
Yeah. And if you get the rent increase, great. You got some upside. Even if you don't get appreciation, even if the asset depreciates and devalues, you still have income. That's what's great about real estate.
Yeah.
What I use the analogy of economic Armageddon. If we have economic Armageddon, which we were facing in 2008-9, we faced with the pandemic. Let's say the dollar is worthless. There is, it's just whatever. If you have housing, you have something of value that people need that you can exchange for. So at the end of the day, property is what the wealth of the world was built upon at one point. It's all about how much property you had.
Yeah.
And so if everything else is worth nothing, property is going to be worth something, because people need access to property for different reasons, for living, home, shelter, and all that. But, the key to that whole thing is, it also is, financing is really irrelevant too. You can get owner finance deals. You can do lease options. You can do master leases. So there's a lot of creative ways that you can get into real estate as well, and take advantage of it, especially at the single family level. So, it's not just the interest rates, but that's creating an opportunity like we've never seen before. And rents are not going to continue to go up. It's hyper local, it's certain markets, and, it's up and down. So you got to be careful there.
Yeah. The last thing I want to talk about is there was, let me see if I actually have my notes from this morning. I do. There's I don't know, some economic person, Peter Bookvar, whatever. He's basically saying we're in a housing bubble because of the Fed. And his basically his point is, he feels bad for people that got into housing, put 5% down. And what if housing crashes 10%? They can't sell. And I just want to highlight once again, once you're in a 30-year mortgage, you got to live somewhere. If housing values go down, the loan doesn't get called. If you have a housing payment that is affordable, you just keep making the payment. And that's why it's important to cash flow day one, right? So again, just because values fall in a single family residential loan in the US, it doesn't mean you have to sell, right?
Yeah, absolutely. It doesn't mean you have to. Now, certain loans that can put you in what's called technical default, when
Yeah.
the value falls below a certain level and,
Commercial,
your
yep.
financial circumstances change, things like that. But generally the banks aren't going to come knocking on your door as long as you're making the payments. Now, in 2008 and 9, banks were calling loans on certain properties, and especially commercial and development and things like that were
For
not
sure.
in default. They were just saying, hey, well, we want you to pay this off.
Yeah. Pay it off or bring more money to the table. Again, that's why I'm not touching commercial. Because again, I think rates will be up higher in a decade than they are now. But again, if you buy a house, you got to live somewhere. I think rents are going up. I think being on the property ladder is going to be more important, not less important this decade. But yeah, folks, people that don't know real estate shouldn't talk about it. If you in a 30-year fixed rate mortgage and your property value goes down 5, 10, even 50%, it doesn't mean you have to sell. The reason we had last crash is because people were in adjustable rate mortgages and their mortgages adjusted and then they couldn't afford them and then they sold. That was a big blow up. So,
well, that, a lot of it was strategic default. They were just like, I don't want to make this payment. I'm not going down that road. We've lost value in the house. I any money I put into it's going to be lost money. So people were just walking away from them. And in my market, vacation rental houses, they were selling all of the furnishings in the houses and then and leaving them and turning them back over to the banks. So
yeah, crazy.
It's really interesting, and it's a different environment now. But I do think psychologically, a lot of people are counting on that as their wealth, as their net worth and things like that. And I think psychologically it does something to you if all of a sudden you've put $100,000 down on a house and it's worth, half as much as you paid for it and your down payment's gone. That will affect people's decisions and lifestyles moving forward. So when you lose all your equity and your down payment, that will change your perspective and how you live your life. That will change behavior.
Absolutely. No
at the consumer level. So what I mean is there will be repercussions in the economy if we have an incident and housing, crashes 20, 25, 50% across the country.
Yeah, absolutely. Again, we're not calling for it, but yes, there will definitely be ramifications. So do me a favor, Greg, how can people follow you, get part of your world?
GregDickerson.com. All my info is there. YouTube channel, podcast. You can find me there.
Very cool. Thank you very much, buddy.